Here we have a series of transactions that this organization entered into, and they all involve exchanging common or preferred stock for either cash or services or some other non-cash consideration. So I've listed each stock entry separately, and we'll just go through each one. So on February 18th, we issued or sold 2 million shares for $9, and that indicates it's the market value. So we get cash in the amount of 2 million shares times the $9. So we receive $18 million. We debit cash, and then common stock goes up for the 2 million times the par value per share, which is $1. So the difference goes to paid-in capital in excess of par. Very simple. The second one, a little more challenging. It says that we didn't get cash in exchange for these 40,000 shares. We received some legal services from some attorneys, and we're not told what that legal service is, if we have some sort of a lawsuit that's pending or whatever. So we're going to debit legal fees, be an expense account of some sort. Perhaps we're not given enough information here, but the question is, how much do we debit that legal fee expense for, because we don't have a value here. And the rule states, I've got it listed down here, that when we have stock issued in a non-cash transaction, you do one of two things. You either take the fair value of the stock or the fair value of the property or the service that you've received, whichever one is more clearly determinable. So we're not really told what the billing rate is of this law firm, or what we would have had to have paid had we paid cash. That would have indicated what the fair value was, so we can't determine the fair value of the property. The question is, can we determine the fair value of the stock? And the answer is yes, because we're only one day out from when we issued 2 million shares. And when we issued those 2 million shares, we know they sold for $9 a share on the open market. So we can assume that within that one day, the fair market value of the stock hasn't deviated a whole lot. So we'll go ahead and we'll book the legal fees at 40,000 shares times the $9 per share, $360,000, and we'll book to that common stock account the 40,000 shares times the $1 par value, and then the paid-in capital in excess of par is the difference between the two. On the 19th, we sold 80,000 common shares and 4,000 preferred shares, and that was for a total of $945,000. So we are going to get cash of $945,000. And now the problem is we have to split it between the common stock and the preferred stock. And we learned two ways on how we can split that 945 between the preferred stock and the common stock, and the preferable method to split that up is using what's called the proportional method. We can't use the proportional method here, because to use the proportional method we need to know both the fair market value of the common stock and the fair market value of the preferred stock. Now we know the fair market value of the common stock, but not of the preferred stock, so we can't take a proportion of that 945 and allocate it out between the two different types of shares. It won't work. So instead we use what's called the incremental method. And the incremental method is used when you know the fair value of one of the two or one of the three or whatever, how many ever shares of stock you are issuing. And in this case we know the fair value of the common stock. So maybe I could do this right over here. The common stock has a fair value because we're only one day away from the initial sale price of these 2 million shares. So we'll assume that the fair market value of the common stock is $9 a share times the 80,000 shares that we issued. So there you have, we know that we've issued, the fair market value of those shares is $720. So we're going to allocate to the common stock $720,000, and we're going to then take the difference and push that to the preferred stock. So the amount going to the preferred stock is the difference between the cash received and the amount allocated to the common stock. So $225 will go to the preferred stock, and $720 will go to the common stock. So let me just put in the common stock here. And but remember, this is the total proceeds that are allocated to each type of share. So we still have to go through that whole process of saying, okay, going into preferred stock are 4,000 shares times the par value per share, and they tell us way up here that the par value per share for the preferred stock is $50. So $200 goes to $200,000 goes to preferred stock, 200 to the 225. That means there's 25,000 left over, that goes to paid in capital in excess of par for the preferred shares. So the common stock we're going to allocate of that 720, there are 80,000 shares times the par value of $1. And so we would also have, let me just put another space in here because I'm short one. We would have paid in capital in excess of par, but this is going to be for the common stock. And it's going to be the difference between the amount we allocated to the common stock from the proceeds of the 945 and this amount that went to the par value. So hopefully here our debits equal our credits. Let's just check that out real quick. And the answer is yes, 945 on both sides of the transaction. So that's how you would allocate and split up this lump sum into different shares using the incremental method. The proportional method would have been slightly different. Okay, lastly here on April 3rd, and what's important to note is April 3rd is a significant departure from February 18th. You know, we're more than a month and a half removed here. That tells us that the fair market value on the 18th probably no longer holds. Lots of things happen in a span of 6 weeks. And we issued 380,000 shares of our common stock in exchange for equipment. The equipment has a cash sale price of $3.7 million, and we know this. So no cash changes hands, and so when we have a stock issued in a non-cash transaction, again, we have to look at the fair value of the stock. And the argument is we don't know the fair value of the stock. Because we knew the fair value of the stock on the 18th was $9 a share, but we're 6 weeks removed from that. So we can't use the fair value of the stock. We use the fair value of the property, which is $3.7 million, and we record the equipment into our books at $3.7 million. And so the common stock, we issued 380,000 shares times $1 per par value per share. And so the difference between the two goes to paid in capital in excess of par. Remember, this number is really important because this is capitalized on the balance sheet now. It's a long-term asset. It'll be depreciated over time. And so when analysts look at our balance sheet, you know, they get a certain indication of liquidity and risk and those sorts of things based on the size of the assets that we've booked. So those are the transactions and how they would look given this problem.